Welcome back, fellow investor. As always, I'm your host, Brian Davis, co-founder of Spark Rental. I'm on a journey to reach financial independence, and I'm on that journey with you guys. We get together every month as an investment club in our co-investing club. We vet different passive real estate investments. We bring in sponsors to talk about their latest deal. Uh, our members invest in those deals together. We all chip in small amounts of money to invest in these together, and it's a lot of fun to invest alongside other people. And part of what makes it fun is we also bring in experts every month, subject matter experts, to talk about their specific niche and how that applies to real estate investing and tax planning. So we get to bring in a lot of those guest experts onto the podcast as well. So today we've brought in Sean Lovison. He is a certified financial planner. He's also a CPA. He's the founder of Purpose Built Financial Services. And one of the things that I wanted to do today that's a little different than usual, we almost always talk about real estate investing, whether it's active or passive. I wanted to talk a little bit about stock investing today as well, how that fits in with your portfolio. And, how do you approach your stock investments when it feels like we're at the top of a market? I was telling Sean before we hit the record button, I was logged into my brokerage account earlier today, and I had some cash sitting in there that I wanted to invest in the market, but I was so reluctant to do it because it just feels like we're at the top of the stock market. So, Sean, how do investors approach that, as retail investors? And, how do we invest, when it feels like the stock market is really, really high at the moment?
All right, so I had to start off all of these conversations with like Yoga Bear's quote, right? Predictions are hard, especially about the future. So I
Yeah.
don't have a crystal ball any more than anybody else, and I certainly understand the investor sentiment right now. Like the stock market's been up by the S&P 500 by 26% over the past year. Over the past 3 years, we're averaging 16.5%. So, these are some big highs and big numbers, especially when a lot of investors like you or I are used to basically the lost decade, after the, dot-com crash, right? So we have some big numbers, but a lot of that is the catch up from so many slow years as well. Like when you look at the longer term time frame of the last 20 years, we're not that much above the long-term average of 10%. I think that we're like 11% or so. So, I mean, it's not a huge increase from that. And there's a lot of positive things that are still happening in the investing market. Like earnings per share have grown at like over 9%, which is above the long-term average over the last couple of years, because you still have a lot of companies that are making a lot more money than they used to. And that could be driven by the AI, boom and that revolution. There's a ton of investing. So people are building out data centers faster than they ever have. You have a whole shift of trying to integrate that into everything from manufacturing to finance to real estate, whatever you're talking about. I mean, AI is coming everywhere to help you analyze products, and that's really, leading to a lot of new productivity gains, which is what generates improvements in the marketplace. Now, whenever you are investing, you also have to remember that you need to stay the course of what your investment philosophy is. So it's important to like sit down and think about in a calm moment when you have a beer and you're not like worked up over anxiety of the market. Come up with what your investment plan is, because you need to stick to that. JP Morgan did a study, and over the last 20 years, if you just missed the 10 best days of the market, your returns were cut almost in half, right? And if you decide to pull your money out of the market and not invest, you have to decide when you're going to get back in. So, you need to come up with an investment philosophy and stick to it. And that's one of the places where I do think that real estate can be a big component of your investment philosophy. When you are calm and when the markets are normal, sit down and say, how much of my portfolio do I want to have diversified into assets that are uncorrelated to the stock market? Because that will create an environment where you're less concerned when the market does go down. And I do think that real estate is one of those beneficial assets to have your money in, because if nothing else, especially when you're outside of REITs, we're going to leave REITs as a separate category because they move with the stock market a lot. But when you talk about other real estate investments, they don't move with the stock market. And it's almost impossible to kind of check them every single day and say the sky is falling, right? So when you have amounts of your money invested in your portfolio in real estate, that is a relatively stable, investment that you may have that can keep you calm when the markets are more volatile. So I think it's important to stay the course and make sure you have some of your money invested in those assets.
Yeah, no, I couldn't agree more. And I will just say, as a stock investor and as a real estate investor, Almost all of my asset allocation is in those two asset classes in stock and real estate. I have a little bit of play money in crypto, but it's certainly not where I'm putting all my eggs in that basket. Yeah, the real estate, the more stability and the less volatility in real estate helps me sleep at night, even when the stock market crashes. As someone in my 40s, I know that the market's going to go up and down quite a bit before I retire, so I don't have to lay awake at night worrying about it. But even if I were older, the real estate investments do provide that element of security and stability in your portfolio, where you're not watching your entire net worth crash alongside the stock market.
Right.
And one thing that my partner Denny and I have talked about many times on this show and on our blog and elsewhere is the folly of trying to time the market. I mean, and we see this, obviously among stock investors, we see this among real estate investors, even home buyers. They say, oh well, the home prices are really high right now. I'm going to wait until the market dips down a little bit before I buy. You know, the market could rise another 20% before it drops 10%, right? And so the low of next year or 2 years from now might still be way higher than today's pricing. So yeah, it's super folly to try to time the market, whether that's stock
100%.
markets.
I mean, talking about real estate investments, I have what, four investment properties. And I don't think that at the point that I bought any of them, I really felt like it was a crash, right? Every time I bought one, I thought I was paying peak dollar or top dollar, a fair amount, but top dollar for the investment property that was available to me, right? But then you look back at it, 5 years later, 10 years later, and you're like, wow, that was a steal. If I could go back in time and buy more at that price, I would.
Exactly.
So, you have to stay the course and say, hey, if I'm going to invest a certain amount of money every year in real estate, follow through and invest that money. That's just part of good asset allocation. That's part of your investment philosophy. Stick to it and don't try to time it.
All right. Well, I do have to ask you one quick question before we wrap up for today. You touched on AI, and I've heard the case made that we are in an AI bubble right now, that there's no way that these big tech companies, or even any other company that is incorporating AI, there's no way that they will be able to recover the amount of money that they are investing in AI from higher productivity or profits from their AI boosted business. So I'm just curious about what are your thoughts on that as a certified financial planner?
So this is the best analogy I have for the AI boom and possible bubble, right? I think that it's going to end up like the Broadcom access, like broadband access to the world, right? When that was getting built out in the 2000s, they went rapidly ahead of the demand, and at some point in time, they realized that they basically had too much for the current time frame. But it wasn't necessarily a bubble. Like they didn't, that it wasn't like that didn't get utilized. It just took longer for the demand to catch up. And eventually now we're trying to expand well past what we even currently have. And I think that the AI might end up in the same stratosphere. Like, we're going to probably expand that out past what we need at this exact moment. But I think we'll very quickly catch up to that level of demand because it is such an impactful technology. I mean, it is going to affect every area of the world, really. I mean, I can't think of any industry that's not going to be impacted by AI. So there's going to be a long cycle of that getting down to the lowest common denominator, the lowest business, right? Because there are manufacturing like companies. I used to be a CFO of a manufacturing company. It takes them a long time to integrate new technology into those business organizations. So I just think that we'll get to a point where AI build out stops at your Googles and your Metas or whatever it might be, but then you're going to see that flow down with productivity gains throughout the entire economy, and you'll still see that productivity increase that will generate market returns.
No, that all makes sense, and I love the analogy to the Broadcom era. Makes total sense. Sean, thank you for coming in and sharing some of these thoughts. In 30 seconds or less, how do you help people, and how can people connect with you if they want to take you up on that help?
Yeah, well, thank you for having me, Brian. It's been great. And yes, my name is Sean Lovison. I'm a financial planner with Purpose Built Financial Services. We're flat rate financial planning. We do financial planning, wealth management, tax preparation, and tax planning for our clients, all under one flat rate fee. So we try to be there for as much as we possibly can for the clients. We obviously have a heavy tilt towards real estate, which is why I'm on here. And that's part of our ongoing portfolios, and I'm here to help. So just reach out to me. You can find my name on all the social medias, and I'm here to help. Thanks.
Awesome. Well, Sean, thanks again for coming on. And guys, if you enjoy these quick hit conversations that we have with subject matter experts, please rate, review the show. Makes a world of difference to us. And we will catch you same place, same time next time. Wondering how private equity real estate investing works? We get it. A lot of investors are put off by phrases like private equity or real estate syndication, but these completely passive investments are actually a lot easier than buying properties directly, buying properties yourself in your own name. So we offer a free 40-minute class called Hack the Rich, 7 Secrets We've Learned from Private Equity Real Estate. There's not even a sales pitch at the end. We'll show you how to invest in these on your own without any help from us. So go to sparkrental.com/hack to take the free class. And we can't wait to chat about your questions.